Hello, my name is Saket Modi. I'm a London-based financial trainer and consultant. In this video, we will look at IFRS 9 expected credit losses. IFRS 9 is a standard on financial instruments and covers classification and measurement of financial assets and financial liabilities, the expected credit loss impairment model, and hedge accounting. When we look at the interim financial report of the top UK banks for the 6 months to 30th June 2020, we see that there is a significant increase in the impairment and other credit charges compared to the 6 months of the previous year. For example, in case of HSBC, the impairment charge has increased by 5 times compared to the 6 months to 30th June 2019. In case of Barclays, it has increased 3 times. In case of NatWest Group, formerly called the Royal Bank of Scotland, it has increased 7.9 times, while in case of Lloyds Banking Group, the increase is 5.6 times. So what is this expected credit loss model? Expected credit loss is equal to the exposure at default, or EAD, times the loss given default, or LGD, times the probability of default. So for example, if a bank has made a loan of, let's say, 1 million, and if the customer was to default, the loss is, let's say, 40%, because there is some collateral that the bank holds and it will realize 60% of the exposure by selling the collateral. So the loss is only 40%. And let's say the probability of default happening is actually 5%. The expected credit loss is 20,000, and that is what we provide for in the income statement. Now, what IFRS 9 requires is that if there is a significant increase in credit risk since origination or purchase of the financial asset, a full lifetime ECL provision must be made. This is even if there is no default. If there is no significant increase in credit risk since origination or purchase, then a relatively lower 12-month ECL provision is required. ECL provisioning is a forward-looking approach, so requires assumptions and estimates around the collection of cash flows. What IFRS 9 also requires is consideration of macroeconomic conditions, for example, unemployment. So due to COVID-19, since there are changes in economic conditions, for example, GDP, unemployment, real estate index, the macroeconomic scenarios applied by the entities must be adjusted along with their weightings. So what the entities could do is either adjust the scenarios or their weightings or both, and this will have an impact on the provisioning. If you would like to know more about our training courses, please visit our website. If you would like to subscribe to our newsletter, please email us on info@smglobal.co.uk. Feel free to connect with me on LinkedIn. Thank you.